So, you've seen the headlines. NVIDIA blasting past $3 trillion in market cap. 3 trillion. I mean, it's a number so big, it almost feels fake, right? And it immediately begs the question, is this just a massive bubble waiting to pop, or are we looking at the start of a whole new reality? This one question has basically split the entire investing world in two. Today, we're going to cut right through all that noise. We're going to build a solid, quantitative framework to actually answer that question for ourselves.
Here's the game plan for how we're going to do it. First, we'll dig into the trillion-dollar question itself. Then, we'll build a powerful framework for valuing these giants. We'll put that framework to the test with NVIDIA as our main case study. And then we'll add a reality check I call the 3P test. We'll also look at a common trap called the big market delusion, and then wrap it all up with the investing bottom line for you. Let's get into it.
All right, part one, the trillion-dollar question. And this really is the fundamental puzzle that gets everyone so worked up. I mean, seriously, how can any single company be worth that much money? And what usually happens is the whole debate just turns into a shouting match. You know, on one side you have the old guard value investors who just look at a number like 3 trillion and immediately say, no way, impossible, it's got to be overpriced. And on the other side, you've got the true believers, the AI evangelists who say, hey, the market's huge, they're the top dog, the sky is the limit. And honestly, this debate gets us absolutely nowhere. We need a smarter way to approach this. Now, a little history here is super important. Companies with huge valuations, that's not a new thing. I mean, look at this. U.S. Steel hit $1 billion all the way back in 1901, but what has changed is the speed. The acceleration is just wild. Look how fast Apple went from 1 to 3 trillion, and NVIDIA's climb, even faster. Something fundamental has changed in how the market works. And this is the change right here. This is the key. Those 20th century giants like U.S. Steel, they hit their peak value when they were already mature, stable businesses. Their crazy growth days were long behind them. But today's leaders, like NVIDIA, they're hitting these mind-boggling valuations while they're still considered high-growth companies. So the market isn't just pricing what they've done, it's pricing in enormous growth for the future. Okay, so let's get to it. Section 2. It's time to build ourselves a better tool. We're going to completely pivot away from that shouting match of opinions and focus on one single, powerful, data-driven question. This right here is the magic trick. This reframing changes everything. Instead of getting stuck in this endless subjective debate about price, we're going to ask a concrete business question. What does this company actually have to do? What revenues does it need to generate to earn this valuation? See how that shifts the whole conversation? It takes it out of the stock market casino and puts it back into the world of business fundamentals. It's just a much, much healthier way to think. And to answer that question, we need to quickly ground ourselves in this core concept, intrinsic value. Don't let the jargon scare you. All it means is, what's a business worth based on all the cash it's going to produce for its owners over its entire life? That's it. It's the bedrock of any real fundamental analysis.
Okay, I know what you're thinking. A formula. Don't panic, don't click away. This is the engine that lets us reverse engineer the valuation. It might look a little intense, but trust me, it's built on just a few really simple ideas. Let's break it down right now.
See? It's not so bad. It's really just 3 pieces. First, you start with the market cap. That's the number we're trying to justify. Second, you look at its profitability. You know, how good is the company at actually turning sales into cold, hard cash for its investors? And third, you have to account for risk and growth. What kind of return do investors need for taking on the risk? And how fast can the company realistically grow forever? That's all the formula is doing.
All right, time to get our hands dirty. Section 3. Let's take this new framework of ours and apply it directly to our case study, NVIDIA. So we plug in NVIDIA's $3 trillion market cap, and it's just absolutely incredible 53% net margin. And the formula spits out this number, $290 billion in revenue. Now that's a huge number, for sure, but maybe not as insane as you might have thought. But there's a huge catch. This number assumes NVIDIA is a fully mature company right now, today, and we all know that's not the case. And this table right here shows you the catch. I call it the waiting effect. Because NVIDIA is still growing, we have to wait for it to mature and actually start delivering those massive, stable revenues. And the longer we have to wait, the higher that break-even revenue target gets. If we wait 5 years, the target jumps to $406 billion. 10 years, it's almost $600 billion. Why? Because time isn't free in investing. $1 in 10 years is worth less than $1 today. Now here's the second massive variable, profitability. That $290 billion number, it completely depends on NVIDIA maintaining its current, frankly heroic 53% net margin.
But what if competition heats up? What if over time its margins come back down to earth and look more like a typical chip company, say 25%? Well, look what happens. The break-even revenue target more than doubles to $660 billion. So you see, the story you believe about its future profitability completely changes the math. Okay, so now we have our target numbers. But, a number on a spreadsheet isn't an investment thesis. We need to stress test this. In Section 4, we're going to use a qualitative framework to see if the story required to hit these numbers is even achievable in the real world.
And this is it, the 3P test. It's a super simple three-step reality check for any investment story. First, is it even possible? This is a really low bar. Is the market big enough for this to even happen? Second, is it plausible? Can you actually map out a pathway, even if it's a long shot, for the company to get there? And third, and this is the toughest one, is it probable? Is that pathway not just some fantasy, but one of the most likely outcomes?
So let's run NVIDIA through this test. Is the revenue target possible? Oh yeah, for sure. The AI chip market is gigantic. That's an easy check. Is it plausible that NVIDIA could get there? Yeah, I'd say so. If you assume they maintain their iron grip on the market and keep those insane margins, you can see a path. Check. But is it probable? This is where it gets really interesting. For a skeptic, believing that NVIDIA can keep 53% margins for a decade while every tech giant on the planet is trying to compete with them, well, that's probably not the most likely outcome. For many investors, this is where the story starts to break down.
And just as a quick point of contrast, look at a company like Tesla. Because its current profit margins are so much lower, its break-even revenue target is over $2.2 trillion. That's a number so huge it starts to fail the very first test. Is it even possible? The only way that story works is if you believe whole new businesses, like robotics or self-driving, will come online with way, way higher margins. It really shows you the scale of the challenge.
Okay, let's move to our next section and zoom out for a minute. We've been looking at individual companies, but sometimes the biggest mistake in logic happens when we look at the whole market all at once.
And this brings us to a concept I call the big market delusion. This happens in every hot new market, and AI today is the perfect example. Every single company tells a great story about how they're going to be a massive winner. The delusion happens when you add up the implied revenues needed for all their valuations, and that total number is actually bigger than the entire market they're all fighting over. It's simple math. They can't all be right.
And this chart shows the delusion happening in real time. This is the large language model space. Think OpenAI, Anthropic, xAI, all those guys. Their collective valuations in the private market are over $1.5 trillion, but their collective revenues? A tiny fraction of that. The break-even revenues needed to justify those valuations are astronomical. It's a classic case where the market as a whole is pricing in an outcome that is mathematically impossible for everyone to achieve. Okay, let's bring it all home in our final section. We've built the tools, we've run the tests. Now let's talk about how you can actually use this in your own analysis.
So here are the 4 big takeaways I want you to remember from this. Number 1, highly priced does not automatically mean overpriced. Just reframe the question. Number 2, always use the 3P test. It's your sanity check for any investment story. 3, allow room for disagreement. Your idea of improbable might be someone else's plausible. The goal here isn't to be an evangelist, it's just to have a smarter conversation. And finally, number 4, perform reality checks. Constantly. When the data changes, you have to be willing to change your story. Don't ever fall in love with your own assumptions. So I'll just leave you with this final thought. The next time you see a headline about some company smashing a new trillion-dollar record, you'll have a new set of tools in your belt. You won't just ask that simple dead-end question, is it overpriced? Instead, you'll be able to ask the much, much more powerful question, what will it take for this business to actually get there? And can I build a story to get it there that isn't just possible, but is actually probable?